friend of mine checked her OAS payment and thought Service Canada had made a mistake. They hadn't. The amount was smaller than she expected. And the reason didn't start with the payment she was looking at. It started months earlier. In 2025, her income crossed a number she had never heard of before. Not by hundreds of thousands of dollars. Not even by tens of thousands. Just a few $1,000s. But that small difference pushed her into a completely different OAS calculation. And here is what makes this so easy to miss. The income that triggered the problem happened in 1 year, but the effect showed up in her OAS payments the following year. For the July 2026 to June 2027 benefit period, the OAS recovery tax threshold based on 2025 income is $93,454. If your income is above that amount, the basic recovery calculation is 15% of the excess. Now, before you panic, crossing $93,454 does not mean you lose all your OAS. The CRA does not take 15% of your entire payment, just the amount above the threshold. But the real problem, a lot of Canadians do not realise they are getting close to that line until after they have made the move that pushed them over. A large RRSP withdrawal, a RRIF payment, strong investment gains, a capital gains event, or simply working a little longer than expected. And that is when the questions start. Why is my OAS smaller? Why am I paying money back? Today, we are breaking down the OAS recovery tax in plain English. We will look at the numbers, the 3 common income traps, and 5 legal planning strategies to protect your retirement income. Let's start with the number at the centre of it all, $93,454. For the July 2026 to June 2027 period, the threshold based on 2025 income is $93,454. If you have spent decades working, paying taxes, and contributing to the economy, it feels frustrating that your OAS depends on your income. That is why people call it the OAS clawback. Let's look at how the 15% calculation actually works using a simple example. Imagine your calculated income for the OAS recovery test is $100,000. The threshold is $93,454. The amount above the threshold is $100,000 minus $93,454, which equals $6,546. Take 15% of that excess. $6,546 times 15% is $981.90 for the year. It does not happen all at once, and the CRA handles it through tax returns and future OAS adjustments. The biggest takeaway here, it is a timing problem. You earn the income in one tax year, the CRA uses it for the recovery calculation, and the impact shows up during the next benefit period. So how do ordinary retirees accidentally cross that line without getting a massive pay raise? Let's look at the 3 hidden income spikes. First, retirement account withdrawals. This one catches people off guard because it feels like you are just taking money that already belongs to you. You worked for it, you saved it, then 1 year you need cash, your roof needs replacing, your car gives up, you want to help a grandchild, or you just want to enjoy some of your savings, so you withdraw $30,000 from your RRSP or RRIF. Nothing illegal, nothing unusual, but that withdrawal is taxable income. If a retiree normally has $75,000 of income, safely below $93,454, and adds a $25,000 RRSP withdrawal, their tax picture changes drastically for that year. To the tax system, it looks like additional taxable income. Add in mandatory minimum RRIF withdrawals as you get older, and you can easily get caught between needing to live your life and triggering an accidental OAS clawback. The lesson here is that a large 1-year withdrawal creates a completely different tax picture than a carefully planned withdrawal strategy over time. Second, investment income that does not feel like income. You might think, I do not have large RRSP withdrawals, I am just living off my pension. Then you look at your investment account. Your income is not just what hits your checking account every month. Interest, dividends, and taxable capital gains all count. Imagine you sell some long-held shares to fund a home renovation. The money you receive from selling that investment is not treated like a tax-free TFSA withdrawal. Taxable capital gains push your calculated income higher. A person who thought their income was $80,000 suddenly discovers their calculated income is well past the threshold, and the same goes for working after 65. Part-time consulting, a small business, or a few extra shifts can quietly push a collection of smaller decisions right over the line. Let's put this together with Margaret. Margaret is 68. She has a workplace pension, does some part-time consulting because she enjoys it, and has investments. She does not live extravagantly. Then 2025 happened. Workplace pension income, consulting work, investment income, plus a larger than usual RRSP withdrawal for a major home repair. Individually, none of these felt dramatic. Together, Margaret's calculated OAS recovery income hit $110,000. The threshold is $93,454. The excess is $16,546. The basic recovery at 15% is roughly $2,482 for the year. Margaret's OAS did not vanish, and the government did not make a mistake. Her income simply crossed the threshold. Could she have managed the timing differently? Maybe. But remember, the goal is not to make your OAS number look as large as possible. The goal is to keep more of your overall retirement money after taxes. What if Margaret's income was $110,000 in 2025, but 2026 looks completely different because she stopped working or stopped making major withdrawals? Do not assume the CRA automatically knows your income dropped. Because the system lags, you might still see an OAS recovery tax on lower current income. If your circumstances change significantly, you may be eligible to request a review or reduction of OAS recovery tax based on your estimated current year income. More importantly, do not make the mistake of trying to dodge the threshold at all costs. If you spend $10,000 in fees or give up $20,000 of income just to avoid a $2,000 OAS clawback, you did not win. Instead, let's look at 5 proactive planning strategies. Strategy number 1, pension income splitting. If you are married or common law and one spouse has a large pension while the other has very little, eligible pension income can often be allocated between spouses for tax purposes. This can balance out household taxable income and keep one spouse from getting crushed by the threshold. Strategy number 2, leverage your TFSA. TFSA withdrawals are generally not included as income for the OAS recovery tax calculation. If you need cash for a major expense, choosing to pull from a TFSA instead of an RRSP can keep your taxable income flat and protect your OAS. Strategy number 3, plan ahead for RRIF minimums. By the end of the year you turn 71, your RRSP must become a RRIF, forcing mandatory withdrawals. Planning strategic, smaller RRSP withdrawals before age 71 can prevent a massive, unavoidable income spike later in life. Strategy number 4, consider deferring OAS. You can delay starting OAS past age 65, boosting your monthly benefit by 0.6% for every month you defer, up to 36% more at age 70. If you are still working a high-paying job at 65 and do not need the cash, deferring lets you bypass the clawback during your highest-earning working years. Just note that you should not do this if you qualify for the Guaranteed Income Supplement. Strategy number 5, time large taxable events. If you are planning to sell a major investment or downsize, do not look at the profit in isolation. Check what the taxable capital gain will do to your income before you execute the sale. Sometimes spreading transactions across different tax years makes a massive difference. Before you make your next financial move, run through these 4 quick steps. Step 1. Check your 2025 income. Look at the actual numbers the CRA uses for the July 2026 to June 2027 period. Are you near $93,454? Do not panic. Remember, you only pay 15% on the excess. Step 2. Break down your sources. Separate your pensions, CPP, employment, investments, and withdrawals so you know exactly which engine is driving your income. Step 3. Plan before you move. Talk to a professional before you make a major withdrawal or sell a major asset, not after the damage is done. Step 4. Look at the 10-year timeline. Do not optimize for a single tax year. Balance your RRSPs, RRIFs, TFSAs, and OAS start dates to win the long game. The OAS recovery tax is not something to fear, it is something to map out. Take a few minutes to check your numbers, because the best time to understand the threshold is long before you cross it.